We will now give the floor to Roberto Violi from the Bank of Italy. Risk aggregation, tail risk and correlation, capital allocation efficiency, and regulators set standard models for bank capital. The floor is yours.
All right. Thanks very much for the invitation. I think this is going to be not an easy presentation, fortunately, partly because I will try to convey a message that is a mix of theory and practice. And the theory, of course, has to do with the first part of the title. The practice has to do with the regulator set standard models for bank capital, which is, for me, a way to discuss a little bit problems that are related to financial model, of course, but with a perspective that, first of all, has to do with what the regulator is doing with modeling. We are going to concentrate not to the whole spectrum, if you like, of the modeling used by regulators, financial regulators, but we will give you a specific example which is very relevant these days, and I think it can provide a sense, I think, of the issues that may be involved. I think what I like to point out is that those issues have really huge practical implications. I think it's clear, I think, to everybody, and also sometimes this morning in some of the presentation, the last one, there was some reference to that. Bank capital clearly was one of the issues during the great financial crisis, and that, of course, has triggered a lot of debate within the regulatory space, if you like, also related to modeling. And we are gonna cover at least a portion, if you like, of those issues, and see in some sense how in what sense models are relevant in the regulatory space, and how much they can impact, I think, on the industry. Again, I'm not pretending to have a comprehensive view on this, but at least to convey a sense of what those issues are, and issues that are still open issues, I think, in my view, these days, and some of the problems that I think have not been solved in full in the regulatory space. I think we are in the middle of a transition in that area, and I think you can get a sense of that transition when you hear to talk about Basel II, Basel II.5, Basel III, Basel IV, and all the rest of it. So it's something that is in transition, and you'll be seeing that. I think the issues, yes, are taken from a regulatory perspective, but clearly they are also relevant not only as for the impact on the banking sector and financial markets as a whole, but also from, I would say, from the private sector perspective, because some of the issues, I think, also belongs in some sense also to how a risk manager in a private sector institution is managing risk. So you can see that it's a bit complex story. Well, a couple of points I like to make before entering into my story is I decided to have this Albert Einstein supposedly quote pointing out that we should make everything as simple as possible, but not simpler. Now, this is, if you like, a message to the regulator, which is a bit subtle at this point. It may also sound as a criticism. It's not meant like that. I think it's a stimulus, if you like, to try to, I think, to adhere as much as possible with this very simple concept. Very simple to say, far from easy to implement. Let me say that, but I think it's good to remind that. The other thing is, I'm from the Bank of Italy. It's very important, the caveat, if you like, that is very standard here, and namely, these are my own views, and they should not be quoted as the Bank of Italy's views or the Eurosystem of central banks views, etc. So they are my very personal view, if you like, on the issues that we are going to discuss today. And please keep it as such, as personal views, personal opinions. Of course, some of them are, I suspect, shared by my colleagues, not necessarily all of them. Well, maybe a third point is that I work in the financial markets and payment system department, so I'm not directly making regulations. I'm not working in the supervision department of the Bank of Italy, and so my view is a view that is taken again, one could say, from the if you like, investor perspective, which is in a way more, if you like, more is closer to, if you like, to the private sector on the one hand. But I think my role as part of, broadly speaking, of the regulatory framework, at least here in Europe, makes me in a sort of advantageous position to discuss issues from both sides, if you like, of the coin, namely from a regulator standpoint first, but also as an investor, in the sense that my role in the department has to do with financial investment, and therefore this makes my work pretty much related to financial markets issues. Let me start by giving a brief summary of what is, in fact, the paper, the first draft of a paper. And in this summary, I will try to highlight the issues that are tackled in the paper in the first place, and then we will try to at least touch upon the main ones, if we have sufficient time, hopefully. And then in the end, we will draw some conclusions and perhaps point to certain way forward that I feel are important to tackle some of the issues we are going to see in this presentation. I think it's perhaps important to start by basically making clear what the focus will be in this paper, which is, as I mentioned, the capital requirement and the level of capital. Broadly speaking, I would say in the financial industry as a whole, but in my presentation, I'll be really concerned with the banking sector. There are a couple of references to insurance companies as well, but it's very peripheral. So my focus is really the banking sector. Now, in this perspective, I think the audience may be familiar with the view that the regulator has some rules, criteria to define regulatory capital, which is in the literature also made or compared, let's say, to what is called the economic capital. The two notions may not coincide. In fact, there is no reason that they should necessarily coincide, although they can't really be too different. I think here we're going to be concerned with the regulatory notion of banks capital, the notion that has been developed in the last 20-25 years with Basel regulation, I would say, speaking about banks. And in that framework, we're going to see some of the principles that are guiding the determination, if you like, of banks' capital as laid out in the banking regulation, so in the so-called Basel approach to banking regulation. I think in this context is important to have I think the very basic notion in mind, especially for those that are not very familiar with the regulatory approach. And I think the very important distinction has to do with two broad types of capital requirements that are set within the banking sector and set by the regulators. One is the so-called internal model approach, and we're going to say a little bit more later on this. But what is even more relevant in our presentation, in my paper today, has to do with the so-called standardized approach or approaches to capital requirement. And also among them, what sometimes is called the simplified standard approach. Now, this simplified standard approach would be the focus of some of my discussion later on in the paper. But I think what is important at this very early stage is to distinguish between internal model and standardized approach model, if you like, of capital requirement. Now, with the internal model, essentially what you have is some freedom, if you like, that is given to the single bank, to the individual bank, to use its own so-called internal model of risk to determine the level of capital that is suitable for the bank. Now, one has to be clear on that, although we don't have time to elaborate too much on this. Of course, the internal model has to correspond to certain broad guidelines that are given by the regulator, so it's not a fully free exercise. And also, I think more importantly, there is a validation process that is preliminary to any, if you like, authorization to use the internal model. And of course, that validation that is carried out, validation exercise that is carried out by the regulator gives the stamp of approval, if you like, to the internal model. Now, for the standardized approach to capital requirement, things are different in the sense that basically the regulators fixes the model, if you like, and the parameters, basically, of a model that being standardized and in its simplified version, aiming to be relatively simple and not too difficult to implement, will be typically reserved, if you like, for smaller banks or banks that do not have an internal model, they then don't want to use an internal model, although here in the regulation sometimes banks are not free to choose, if you like. If you are a very large bank, in some cases you will be obliged to use an internal model that basically you have or you should have, and if you don't have it, you've got to develop it. So we should think of the standardized approach as a model for basically a very large number of banks, even though the sum of the assets of these banks may not be perhaps even as big as the ones for the very large bank that clearly would normally use the internal model. The other thing that I want to underline in this process is that we are going to focus on a particular type of banking regulation regarding capital requirement, and this has to do with the so-called fundamental review of the trading book. Now, this is the jargon that is used in the Basel 2-3 framework, which corresponds basically to the market risk that banks are incurring in their own activity. And for that market risk, banks are required to hold a certain amount of capital. So we're going to focus on that part of the assets of a bank, namely what it is technically called the trading book of a bank. So we are not concerned here specifically about the credit book or something that is not tradable. So the focus here is on the trading book. Now, I think you may sense here the notion that the trading book of the banking sector was very important, was a very important, if you like, vehicle in some sense of the financial crisis of 07 and 08, in the sense that we know that a big component, if you like, of the losses that systemic banks were incurring in those days had to do with their trading book. So it's clearly a very important component, if you like, of market risk in the banking sector. Is probably the largest component. So we, again, even though we are focusing on a particular section, if you like, of market risk, it's a very important one, I would say. Here I think we can now move a little bit, having said that, and then in this focus on the capital on this capital market activity, if you like, of the banking sector, we will discover, so to speak, especially in this new regulation that the FRTB was mentioning to is going to implement relatively soon. Here is probably relevant. I will then bring forward some of the comments that I will be making. Here, I think it's also important to know that those changing in the capital requirement, which were prepared and worked out by now a few years ago. So the debate started, and the very first documents of this fundamental review was published in 2016, and after that there were some changes that were made into the regulation. We don't, of course, go through those details too much. In 2019, it's important to remind that the final version was issued by the Basel Committee, and with the notion that it should have been implemented in 21. Then COVID postponed it to 22, but now there was another postponement end of last year to 25. Now, I think these postponements may suggest that things are not that simple with this regulation. There was a lot of debate in the industry regarding some of those provisions. Certainly, we are not going to review them in details here, although there is some spillover, if you like, of the debate also in this paper. But what is important is that we are talking about measures that at the moment have not been implemented yet, although the regulation is now final, as we understand that, and maybe to also give a sense of the impact, and perhaps I take the opportunity to mention that now the impact that is expected by the Basel Committee is substantial on the banking sector. Namely, it is expected that there will be an increase in regulatory capital, which refers to the standardized approach, to the simplified standardized approach, that would be as much as 30% on average from the standardized approach, and 58% increase from the current level, meaning um, for the simplified standardized version. Now it's interesting to know that for the internal model, the increase is smaller than these figures. Now we are not going to dwell again too much on these implications. I just wanted to highlight in this way the relevance that this new regulation has for the banking industry. And clearly, in some cases, things have not been taken sort of easily by the private sector in this regard, especially for the standardized approach, which, as I said, will be taken up by a relatively large number of banks, at least those banks that have a trading book activity, which is not the whole, if you like, banking sector, but it is clearly a large part of it. Let me go quickly here. I'm providing a description in broad terms how the approach for capital requirement works. Basically, this applies also to the internal model. A risk measure is identified as the relevant one. Could be, in the financial jargon, could be measure like certain number of standard deviation of the losses. Could be value at risk. That's another very popular measure in this space. Could be expected shortfall, which is basically a measure of tail risk. So in the loss part of the probability distribution of the bank portfolio. So basically, this risk measure is at the heart of the determination of capital requirement. Essentially, the idea is there is a particular risk of incurring into losses, maybe with some probability, and that loss has to be covered by the amount of capital that a bank has posted, if you like, in his books. This is basically the logic. Now, here then comes the question as to whether there is alignment of interest, let's say, from the regulator and the corporate or banking sector. And clearly, the alignment of interest is far from perfect now, beyond principal agent issues, if you like. Here, it's really the if you like, the social welfare function of the regulator that differs from the profit maximizing for given level of risk that a classic banking institution will be undertaking. So basically the regulator, of course, which cares a lot about the loss part of the distribution, will tend to be more risk averse than perhaps a classic financial institution. Now, the other thing here, speaking about banks, being banks a very leveraged institution, of course, the risk of losses tend to be kind of more problematic. First, and secondly, there is really an issue here, because systemic risk for the banking sector can really have a huge impact on the economy. So these considerations, which I think loom very large in the eye of regulators, tend to make the regulator, in principle at least, now in practice things may be more complicated, to be more risk averse than let's say the average bank, because the interests are not in that sense fully aligned. The regulator has to internalize the if you like, the externalities, the impact that the systemic crisis can have. I think we have seen all of this during the great financial crisis and also during the COVID crisis in some sense. So I think one has to bear in mind, in principle, that there is, if you like, a risk-averse bias in the regulator eye when he looks at he or she looks at the banks risk and capital. Um, One, I think, of the issue that I think have become more important, and there was more awareness after the financial crisis, where the regulator, I think, became more skeptical about the internal model approach. Now, the internal model approach was basically started with the first revision of the Basel Agreement, so the Basel II in 96 or so. In those days, the internal model was introduced as a concept, and in those days, the regulators overall were, I think, more inclined to put trust on the modeling ability, let's say, of the private sector, but also on the ability that the regulator should have in validating a particular risk model that would be proposed by a single bank to be approved for its use. So that skepticism that came along after the financial crisis, or rethinking, if you like, I think has a bearing on the FRTB, the fundamental review that we are going to discuss a little bit in detail, with an attempt to somehow rather limit the discretion that the banks had in the internal modeling on the one hand, and also tightening up the standardized approach that was used beforehand for the trading book. There was some kind of standardized approach also before this review, but I think now it has assumed, let's say, a prominence that was not there in the first place. So or at least in this revision that is going to be implemented, as I said, in 25, if things will go fine. I think, having said that, the very basics of the risk modeling, again, is also part of the standardized approaches we are going to see. On the other hand, the skepticism I was referring to, as I think made clear that one of the current issue, and we're going to discuss very briefly at the end this point, the issue of model risk became, I think, more clear also to the regulator, and not only in the industry. And model risk is, I think, one of the hot model risk has become one of the hot topic. Also, I would say, in the academic literature. So some papers have come out recently in the last, let's say, 5 to 10 years or so after the financial crisis. But there is still a number of open issues, which are, I think, very difficult ones, and we should expect that debate to go on for a while. Now, my impression is that model risk in the regulator-based modeling is still in its very infancy. There is not much that had so far trickled down, let's say, from this technical literature I was referring to. So I think we can now try to enter a little bit into the FRTB approach, and especially, as I was saying, we're going to deal with the standardized approach, especially in its simplified version, which is also easier to explain quickly, and also to point out some of the issues that are there in the standardized model in particular. Quickly here, I was basically reviewing in these steps that I'm showing here in the chart, in the presentation, what I have just described as the story of the um, standardized approach and the use of internal model as well. Clearly, the standardized approach again serves, if you like, as a proxy. And we're going to see also that, yes, it is somehow rather a proxy of a more complex model, but also it is relevant also for the internal model in setting certain floors that banks that are using the internal models will be subject to, namely the fact that, yes, you're going to have your internal model, but you're going to face a floor in the capital requirement reduction that you'll be allowed to have. In other words, if your internal model would just to clarify the issue here immediately, if your internal model is computing a level of capital requirement that is below the standardized model computation, you're not gonna you can't go down more than 72.5% of the standardized model. So there is a floor to the internal model capital requirement that you're subject to. And this was also one of the controversy with the private sector that was debated. Now, I'm not going to dwell on this, just to remind that again, there are also interactions between the internal model and the standardized model. So there are two different animals, if you like, but but still with some connections that the regulator has kept. Here I have two tables which summarizes what I was just saying about the impact. So the simplified standardized approach will have a very big impact that I've already mentioned, 58%, while the internal model would just be 20% in terms of capital increase. Interestingly enough, there will be banks and very likely banks that here is the table that summarizes it. There will be a quartile of banks that will be seen on average reduction in capital requirement. These are very likely banks that would be using the internal model clearly. So in some cases, yes, the floor will be binding, but you in some instances you can sort of reduce the capital requirement that you're currently having. So it's also part of the problem, I think, for the industry, having this relatively wide variety of impact across the industry. Again, we are not going to dwell on this issue. It's important just to get a sense of the impact, as I was saying before. Now, the standardized approach has some motivation. Some of them I've already mentioned. Basically, it provides a simplified way to compute capital requirement for banks that do not have a complex, let's say, trading book activity. And also the regulators are saying that this would be a transparent way, of course, because everybody will be using the same model, the same parameters. This is perhaps the notion, also consistency across banks in that perhaps rough sense, if you like, of having the same model and the same parameters. And also you're going to be able to compare, if you like, better the impact of market risk across banks. Now, of course, with the internal model, you don't have this ability, of course, to do this comparison. And also the regulators, of course, has a tougher life, of course, in dealing with the internal model. But again, we now remain strictly within the standardized approach, and basically the standardized approach works in this way. To capital requirement calculation, as I said, there is an implied risk measure, and this risk measure is essentially a measure that in practice has to do with or is related to a standard deviation of the losses of a portfolio. Now it could be a very simple way to describe it, but it gives you a sense. Now we know that you can have a standard deviation based risk measure even though you're using value at risk and expected shortfall as a reference. Um, um, Now, quickly, I think it's this is perhaps one of the key points. Namely, there are four types of risk that the standardized approach is considering in its calculation: interest rate risk, equity risk, FX risk, and commodity risk. There is a risk measure attached to it. As I say, basically is the standard deviation of the losses within those risk classes. And then the capital requirement, which you see in the Formula 1, is calculated by adding up basically capital requirements in each of these risk classes with a factor which here is indicated with the symbol SF, with the factor that is applied to the risk calculation, basically increasing the level, if you like, of it. So it's a factor that allows you to, is a scaling factor that allows you to adjust the risk figure. And this is a number that is listed here, which can take values from 1.2 up to 3.5%, depending upon the type of risk. So for equity, it's going to be 3.5%. So these are fixed numbers, basically, that the regulator has set. There is a two-stage approach. I'm not going to dwell too much on it to calculate the risk in each risk class. And this two-stage approach basically has to do with the risk aggregation, which is risk aggregation within a bucket, so to speak. A bucket, for example, could be, if you consider interest rate risk, you can have certain maturity reference to construct the buckets. So let's say 1, 2, 3, 5, 4, 5 years, and so on. And around those buckets, you measure essentially the risk of having losses, and those risks are then aggregated. And here, Formula 3 gives a sense of the aggregation in the sense that you add up those losses, taking into account correlations, if you like, across the various buckets. This is the first stage. Then there is a second stage of the aggregation, which aggregates the buckets with a similar formula. Basically, you measure the variance, even also in this case, the variance in this case of those losses in the buckets. And again, here you have a correlation parameters, which here is indicated with gamma, that essentially allows you to calculate this variance of losses, or standard deviation of losses, more specifically. Now, with these techniques in mind, then you reach, as I said, the measure of capital requirement in each risk class. Here is called delta. Now, the problem here that I have to point out, quite obvious, nothing really new, as we were seeing before, that in calculating the total capital for the bank, you add up the losses, if you like, in each bucket that you have estimated. Sorry, in each risk class that you have estimated. and without taking correlations across risk classes into account. Now, this is quite surprising, I think, I would say, also from the, if you like, practitioner standpoint, for the risk management standpoint, because in this way, ignoring correlation, you are overestimating on a massive scale, potentially, the amount of capital that you're requiring a bank to hold. And this may explain why we were seeing for the standardized approach a large increase in risk capital for those banks that are going to use that. Now here I'm skipping a big chunk of my work here, and I'm sort of jumping towards one of the main conclusion, which is that, and again, the paper, of course, has much more details that I can handle here, but basically ignoring correlations across risk classes here, you are bound to make mistakes, if you like, or very, well, put it different way. You're bound to overestimate the amount of capital based on the risk parameters that you have set as a regulator, in the sense, to overestimate capital requirement by numbers that would be starting, let's say, from 20-30% up to 100%. Again, using correlation estimates across risk classes that would be reasonable, something in the order of 50% on average, 60%, 70%, 80%. These are numbers that may be easily found if you were to measure losses, risk of losses in these asset classes. So here it seems that the regulator has taken a very tough line, as I was explaining before, with let's say this risk aversion view pretty much in light. So that at first sight may sound reasonable. Now here I think again I'm really skipping to the ends of my presentation. So I think here the issue that one can raise is, first of all, while one might argue that risk model can be an explanation of all this, now the regulator hasn't really, at least as far as I can tell, has not elaborated in the documents on this particular point. So it's taken somehow rather for granted. But clearly one could say, look, there is a lot of modeling risk in modeling correlation, even though correlation are modeled for the bottom-up approach that we were discussing before. So the losses within the buckets and across buckets. So there were correlation numbers there. But here it seems that correlation risk is seen as too much to be handled with. And so basically the regulator said, look, since I don't trust measure of correlations across these risk classes, so I am assuming that they are all equal, let's say. So the probability of losses are the same in that sense across asset classes, because this correlation, this perfect correlation assumption is valid only if you have basically the same risk across risk classes. So it's a bit coarse, if you like, approach. There is no sufficient justification for this model risk extreme view, and therefore I think here we have an area where I think the approach can be clearly improved, and in the paper I'm trying to suggest the kind of avenue that can be taken, partly because we have some knowledge about the maximum level of correlation that an asset classes, particular asset class can have with others, if we know, this is a really a technical point, if we know with sufficient precision the marginal distribution or risk distribution of each asset class. So we can set minimum and maximum level of correlations for a particular asset class without going into the extreme assumption of having correlation 1. So this is an area where, in my view, the regulator can improve, I think, the way in which capital requirement is computed for the trading book. But again, one has to remember this risk aversion issue I was referring to at the beginning as perhaps a relevant concern. Maybe again, as I'm saying, I'm skipping other detailed part in the paper. Again, as I was already explaining, I also have a description about the allocation rule that is implied by the regulator choice, which is in principle the so-called Euler allocation principle, which unfortunately, for the reasons that I was referring to, is not in fact exploited sufficiently in full, basically. And my view, this is a pity, because this principle, which is well known also in the financial industry, has the advantage of being consistent with what it is called a coherent capital requirement approach, which basically acknowledge that diversification is relevant. Now, in practice, the regulators at this point in time is not allowing for diversification across risk classes in this standardized approach, because it's assuming that correlations are perfect, so are equal to 1 across risk classes. And as I said, this can make a substantial difference. And the other point is that not having this coherent capital requirement, such as the Euler principle in place, fully in place, if you like, prevent to, if you like, having a consistent approach vis-a-vis one of the standard risk-adjusted measure that is used in the industry, which is the risk-adjusted, the return on risk-adjusted capital, RORAC, as it is called. Because one of the advantage of the Euler principle is that you can get the correct signal, if you like, by your risk measure. In other words, basically, if the total risk as measured by a coherent risk measure would signal whether it is worthwhile to undertake additional, if you like, additional activity in that particular asset class, or whether other asset classes can provide a better risk-adjusted return. So it provides a consistency in using risk-adjusted return measures. If you are in a way or another violating the Euler principle, you can't rely anymore in a standard RORAC measure, and you are not sure whether you're going to get the right signal, if you like, in adjusting your portfolio based on the capital requirement that you have to comply with. So this is one of the problematic implications of the current approach in the standardized approach that we are talking about. I think I like to stop here my presentation. Apologies for having been perhaps a bit blunt in the presentation, hoping first of all of having attracted your interest perhaps in reading the paper, where more details and more explanations will be provided, and maybe I think here we can, if there are questions, we can try to clarify a little bit more what I meant to say. Thanks very much.
Questions? Yeah.
Hello, thanks for your talk. Well, my question was basically concerning this, also related to this last kind of page, and like looking from a regulation perspective, like regulatory perspective, like if you have the portfolios of different institutions in front of you, based on the regulatory data, is it possible to also assign some kind of risk to the actual investments? So the fact, like looking at the portfolios and potentially capital requirements, what is likely to happen for some investments that are maybe commonly held by many institutions. So maybe there are some kind of contracts or securities or stocks that are particularly vulnerable to potential capital adjustments for the institutions. So maybe there's a way to kind of flag those securities. Thank you.
Right. Yeah. It's a very important question, especially from the practical side of it. The answer is yes. Given exactly the fact that, as I was trying to describe quickly, the way in which you come up with the total capital is essentially done through a bottom-up approach. So you start from individual securities, you then aggregate securities that belongs to the same risk bucket. Now the risk bucket could be, as in my example, the term structure of interest rates. So in this case, we are considering, let's say, a bond, which is exposed to interest rate risk as its main risk. And therefore you have perhaps a portfolio of bonds. So those bonds are allocated to these buckets, and buckets here in the interest rate example that I'm making, just for the sake of argument, could be like maturities, and typically they are maturities in this instance. So you have a 2.5-year bond. So the 2.5-year bond would be allocated to the 2-year, let's say, bucket, just for the sake of argument. A 4.5-year bond would probably be allocated to the 5 years, and so on and so forth. So it's a bottom-up thing. And the outcome of this bottom-up exercise, after having aggregated the buckets, as I was saying, and then this would form an asset class, interest rate risk in my example, and so you can identify, since it's a bottom-up construction, you can identify individual securities or contract, if it's a derivative, that if perturbed, if you like, if stressed or anything, you can then measure the impact on your total capital requirement, or even more precisely, the capital requirement of this particular risk class. I think the question here is whether the risk measure is a proper one in the first place, is perhaps the best one. Now here, clearly in the simplified approach is a relatively basic, if you like, risk measure, one can argue in that sense. And again, you may then use the argument that since the risk measure is a bit simplistic, maybe it's not capturing what's happening in the tail, which is what the regulator cares a lot about. Therefore, you say, look, okay, then when I'm aggregating the risk classes, I ignore correlation and say that all the risk classes are perfectly correlated, so I can make up a little bit for what I'm losing on the tail side of the risk position. Which again, in my view, this is not what I was just saying is not written down anywhere, because I think no one would have the courage to argue in this very broad brush way. Now here I'm just I think using this very simple argument to convey a message, which is, yes, of course, you may want to be more risk averse, so you're trying to err as regulators from the risk averse side, but that is not without cost. So my view, and perhaps not only mine, there are good arguments for that, is that having sufficient risk capital is a good idea, is not such a good idea to have the notion that risk capital is not costly, so it doesn't cost anything, it's a free good. Basically, this may sound a far-fetched argument, but in the economic literature, you can even come across to conclusions of this sort, which I think are very questionable in my view. So if you are basically constraining the industry to hold excess capital, you should expect certain consequences. So it's not a free good in that sense. And one consequence is that there are a lot of activities that are now being shed by banks, and so they are going into the shadow banking, if you like. Now I'm making a comment, of course. Go to the shadow banking industry sector and so on, and that is not necessarily a good idea. Partly because the financial supervisor have not an easy task in chasing them in the first place, but also it implies, of course, a playing field that is not leveled. And it's true that a number of business activities have been shed by the banking sector. Now, some of that shedding might have been for good. I'm not questioning that, but maybe some of it may not be a good idea to pursue with this new regulation in particular. Now, the points that I've just mentioned may also apply to the Basel 3 and 4 credit, if you like, credit risk assessment. But here, moving things out of the bank's trading book may not necessarily be a good idea, ignoring the risk of now, how shall I put it, to overreact, if you like, to the financial crisis. Now, I'm aware these are very bold statements. I'm making them just to provide you to some kind of critical thought and way to look at what's happening. I don't mean to be complacent in any way about the importance of capital regulation. I just want to highlight, in some sense, the challenging task that the regulator has to face in his work. Thanks.
Thank you.